Guys, let's be honest here. Hedge funds are beyond screwed, and that's putting it very lightly. I really can't make this up, so we're just gonna read from this article. It says hedge funds mostly missed the stock market rally after muted buying last quarter, and the stock market has rallied 10% from the lows, and hedge funds completely whiffed it. This was some of the lowest buying in the last quarter that we have seen in multi years. You really have to go back to the COVID quarter to see a quarter in which nobody really bought anything. And that's why Warren Buffett is getting so much praise and so much credit right now, because he was actually out buying stocks. And I believe Warren Buffett's firm was the single largest buyer besides Vanguard and Vanguard and BlackRock, and they purchased about $9 billion worth of stock. And really, why is this a big problem for hedge funds in regards to AMC and the broad markets? And let me explain that to you guys, because first and foremost, in 2022, you've seen a lot of shorting, not a lot of buying. So when the markets go through these furious rallies, how do hedge funds make money? How do they lose money? Well, they lose money when their short positions start to go up, which has obviously been happening. AMC has rallied over 50% in the last couple of trading days. Well, they would have made money if they would have bought some stocks, but since they're so heavily weighted to the short side, they're just completely getting sloshed out at this point, at a moment in time where, like we played for you guys a couple videos ago, hedge fund managers are talking about other hedge funds that are down 50% or more for 2022. It has not been a good year for hedge funds, and they missed a great buying opportunity. And especially here in the short term, if things keep going the way they are, which is looking more and more likely every single day that we continue to hold up and continue to move higher. You know, today was not necessarily the best example of that, but it looks like tomorrow might get off on a better foot. The rest of this week might be a little bit more bullish. It really puts the hedge funds in a bad spot, guys. Now let's get into this article. So hedge funds mostly missed stock rally after muted buying last quarter. Tiger Global, Maverick Capital made modest portfolio tweaks. Cant, I don't know if I'm saying that right, reduced some large holdings including Tesla and Meta. It says some of the world's biggest equity hedge funds held back from ramping up bullish bets in the third quarter, likely missing out on a 10% rally in the S&P 500 since the end of September. Firms including Chase Goldman's Tiger Global Management and Lee Ansley's Maverick Capital made relatively modest additions to their portfolios after incurring heavier losses earlier in the year. They also continue to reduce their largest holdings. The conservative posture may eventually look precedent if, as some economists and business leaders predict, the Federal Reserve's recent string of interest rate increases tips the economy into a recession, reversing recent market gains. Tiger Global on pace for its worst year on record with a loss of 54.6% through October, added just 5 new companies to its U.S. holdings. 3 of those stakes were valued at less than $100 million each at the end of the third quarter, and one, PayPal Holdings, was worth less than $5 million. The hedge fund exited 14 stocks. Maverick reported 183 new buys, though most of these positions were worth less than $500,000 each. Ansley's biggest new purchase was a $120 million stake in Avantor Inc., a provider of chemicals and advanced materials to industries including healthcare and biopharma. Last month, Cant management founder Felipe Lafont said his firm still had 70 to 80% of its assets in cash after slashing positions earlier this year. The firm's biggest purchase was a $178 million stake in Lam Research Corporation, a semiconductor equipment supplier. Most of Cant's 16 new stock holdings were valued at less than $50 million. The firm reduced positions in some of its largest holdings, including Tesla, Amazon, JD.com Inc., Microsoft Corporation, and Facebook parent Meta Platforms Inc. Goes on to say, Monday was the deadline for thousands of institutional investors, including hedge funds, pension funds, and endowments, to report certain U.S. equity holdings to the Securities and Exchange Commission through quarterly 13F filings. Andrea and other highlights. It says Andreas Holverson's Viking Global Investors ramped up its stake in Elevance Health Inc. by 59%, making it the hedge fund's biggest U.S. equity investment. The shares gained 5.9% this year. Viking slashed its stake in former top holdings of T-Mobile Inc. by 64%, leaving the wireless carrier as the firm's 17th largest position. Even though Cant poured its Amazon stake, the retail behemoth was a popular buy among other hedge funds, which collectively snapped up about 9 million shares last quarter. That's according to an analysis of 679 firms, more than half of the total that needed to file by Monday. About 121 hedge funds increased their Amazon positions, while 100 paired them. Activist hedge fund Jana Partners disclosed a new 4% stake in healthcare services provider Inhabit Inc., whose shares have tumbled 50% this year. And as you guys can tell from this article, from the 13F filings that we are getting right now, hedge funds, they are not on the right side of this trade. And that's a big point that I want to point out, is the longer the markets keep rallying, the deeper in the hole these hedge funds are going to get until they cover on those short positions. So I do think before we get to a new low in 2022, because let's be honest, like this article just said, if hedge funds, economists, if all of these statistical, references from history we have are right, we're going into a recession. We're probably already in one, but it's probably going to be pretty bad for a while. In that case, the stock market will hit newer lows. But before we get to that level, hedge funds, they're virtually always wrong in large numbers. That's why hedge funds typically underperform the S&P 500 on average every year, right? They just do. That's statistical data. That's a statistical fact. Since the 1950s, hedge funds have statistically underperformed the markets every single year. The longer this goes, the worse off they will be. But I think before you get to a moment in time where the hedge funds just completely capitulate on their short positions and they say enough is enough, you're going to see a blow off top kind of rally in the markets. And I do think if we get some more positive news and some more reiterations from the Fed that they're only going to do 50 basis points in December, it's looking like that blow off the top kind of rally where shorts just massively exit short positions could be very, very shortly. Because at this point, you need to see a lot of buying if the markets continue to go up by hedge funds, or hedge funds are risking going bankrupt. And I personally think, my personal opinion is, even if you've seen a small percentage of shorts covering in the broad markets, in AMC, whatever particular security that you are thinking of right now, it's probably going to cause, a 10 to 20% rally in normal stocks. With AMC, it could be well over 100%. It could be hundreds of percent. And that's just the simple, honest truth. I do think after that blow off the top kind of rally, that's when you're probably going to see more downside in the markets, because hedge funds are going to say, hey, we all collectively covered way too much. The Fed is still raising rates. They're still going to keep rates super high, and we're probably going to new lows, or going to bob around this area for a while. We should probably put on some short positions. By that time, it's probably going to be well too late for a lot of hedge funds, and I think AMC would have already went through a short squeeze by that time. Now, that is only my opinion based off of the purchases, or the lack of purchases, we've seen by hedge funds in the last quarter, meaning that a lot of them, they just had their short positions go against them. They didn't even get to benefit off of the market's rally, because a lot of hedge funds, how they're actually positioned is, a lot of them in this market environment, would have had, call it 60% short positions and 40% long positions to equal 100% of their portfolio. Now, in 2022, if you had 60% short positions, you actually made some money, and that's probably, you know, roughly what Citadel is at, right? Maybe they're 70-30, 70% short, 30% long. That's how they made apparently 30% in 2022. Nonetheless, if you need to see hedge funds get back to a more neutral level, then that could cause a lot of ferocious buying power in the market. So guys, that is going to be all for this video. Hit that like button and subscribe to the channel if you have not already. Thank you for watching, and I will see you in the next one.